This is the White Coat Investor Podcast, where we help those who wear the white coat get a fair shake on Wall Street. We've been helping doctors and other high-income professionals stop doing dumb things with their money since 2011.
This is White Coat Investor Podcast number 365, Disability Insurance with a Friend of WCI. Today's episode is brought to you by SoFi, helping medical professionals like us bank, borrow, and invest to achieve financial wellness. SoFi offers up to 4.6% APY on their savings accounts, as well as an investment platform, financial planning, and student loan refinancing, featuring an exclusive rate discount for med professionals and $100 a month payments for residents. Check out all that SoFi offers at whitecoatinvestor.com/SoFi. Loans originated by SoFi Bank, NA, NMLS 696891. Advisory services by SoFi Wealth LLC. The brokerage product is offered by SoFi Securities LLC. Member FINRA, SIPC. Investing comes with risk, including risk of loss. Additional terms and conditions may apply. All right, welcome back to the podcast. And thanks so much, all of you out there, for what you're doing. Today, we're doing another Friends of WCI episode. I'm here with Tyler Scott. Welcome to the podcast, Tyler.
It's an honor and a tremendous excitement to be here. Thanks for having me.
Well, we're pretty excited to have you here. I should introduce Tyler. I've known Tyler for quite a while now, actually. Tyler happens to be married to our podcast producer. However, he is a dentist by training, currently works as a financial advisor. We'll get into some more of his story about how he started doing that later in the podcast. But he's also been a speaker on the panels at WCI Con. He's been doing columns for WCI for the last couple of years. You've likely read some of his columns. And so he's what we call a friend of WCI. And so I thought it'd be fun to get him on here, especially given his newer expertise since he transitioned careers, and help him answer some, and he will help me to answer some of your questions here on the podcast. But before we get into that, I want to tell you about an opportunity that you have, and it's a great opportunity. And I hope you take us up on it as well, Tyler. But we are opening the call for speakers for WCI Con 25. This is going to be in San Antonio, February 26th through March 1st is when the conference is in San Antonio, all right? But if you want to speak at the conference, you have to apply. It's actually competitive. We had like 250 talks submitted last year. I don't know how many possible speakers, 150 speakers or something. So you can apply to speak for this at WCIevents.com is where you can sign up for that. All right. We get lots of applicants, obviously, and we're only going to be selecting about 30 speakers or so. And so the way to actually win, to actually become a speaker at WCI Con, is not to just submit one topic. Because we already have somebody else doing that topic that we think is going to be awesome. We're not going to pick you to do it too. But if you put in for 3 or 4 or 5 topics, your chance of being selected is much higher. So we do encourage you to submit for all the topics that you can speak as an expert on that you think would go well at WCI Con. So don't just speak, experience WCI Con with your full registration included. Come and really be a part of this 3-day experience. We'll tell you in August if you're notified. We'll announce it to the public in September. And shortly after that, the tickets will go on sale again for it. Again, sign up, WCIevents.com. All right, Tyler, this is a great opportunity. While we have you on here, I thought to talk about disability and disability insurance. And I mentioned before we started recording, I think we've had the wrong message for the last 12 years at WCI. We spend lots of time getting into the weeds about disability and why one rider should be included, one rider shouldn't, and how much you should have and exactly, what company it comes from. And I don't think we've spent enough time telling people they need something in place. They need disability insurance. This really does happen. And so maybe what we ought to start with, Tyler, is let's have you talk a little bit about your personal experience with disability insurance, then disability, and then using disability insurance. So let's have you start by kind of telling your personal experience with that. And I think that'll get the message across a lot more than a more academic discussion.
Yeah, absolutely. So, yeah, as you said, I started my first professional chapter as a dentist. I graduated from Oregon Health Sciences in Portland in 2012. And my intention was to be a dentist my whole life, like most people. And I had a disability insurance policy that I bought right after dental school from Principal. And the original benefit was $4,000 a month. And I continued to utilize my future benefit increase rider for the first several years as my income started to grow. And eventually, at like in my early 30s, our family was growing in size, and these increased benefits came with increased premiums. And so that started to eat up more and more of our free cash flow. And I was an invincible 33-year-old dentist. Nothing could possibly happen to me, super healthy. And I wanted to stop giving so much of my money to the money grubbing insurance companies. And so, I stopped utilizing my future benefit increase rider, and only to find out a couple years later that with Principal, at least, when you've got if you don't exercise that rider for a couple years, you don't ever get to exercise it again. And that wasn't a problem because there was never going to be an issue. I was going to be a dentist for 30 more years. Well, fast forward a few years and I'm 37 years old, and suddenly I'm experiencing tremendous and worsening back problems. And some of that is normal for a dentist, right? We're not the most ergonomic bunch, and some neck and back pain is normal. But this was really bad, and it was worsening rapidly. And so I drug my feet to get my medical work done. But as many, my good wife Megan encouraged me to go take care of myself. And eventually, I saw a provider, and we got imaging, and found out that I had a degenerative back problem. I had the lumbar spine of an 84-year-old. And it was deemed that I could not perform dentistry safely for myself or to my patients. And at 37 years old, I found myself very suddenly filing a claim on my long-term disability insurance policy. And I'm happy to talk more about that story and how that unfolds. But the big picture is that, to be frank, I liked dentistry just fine. I didn't really love it. I picked it, like I think many of us, early in my 20s as a career. And I looked around my community. I met other dentists, and they seemed like they had a good life. I didn't know that I was signing up for over $300,000 of student loan debt at 7%. I didn't know that the macroeconomics of dentistry had changed significantly since my peer group had advised me to go into that field. And the actual lived experience of being a dentist just wasn't everything that I thought it would be. And so I was burning out. My lumbar spine matched my cognitive condition in many ways as it related to dentistry. And so I had started experiencing this during COVID, where the dental clinics were closed. The back pain was bad. And during those 3 months when I didn't go to work, my back pain was a lot better. Turns out not doing dentistry really helped me not be in as much pain. I was much happier. I was a better husband. I was a more engaged father. And the seed was planted in my mind that maybe dentistry isn't for me forever for a number of reasons. And it was really my friends, my anesthesiology friends, my radiology friends, who got me thinking about doing financial planning. They're the ones who told me, hey, man, you've helped me get my student loans figured out. You've helped me optimize my backdoor Roth and my 401k. You've explained that stuff to me in a way that's more clear than my financial planner ever has. And you could really have a future in this, particularly given that you lived the life for so long. And I had been a white coat reader since I graduated dental school. So, I had a sort of self-taught basis of knowledge. I used that time during COVID to go back to school. I enrolled at Cal Berkeley in the Certified Financial Planner coursework. Loved it. It filled out a lot of my understanding I had learned from you, Jim, through the years. And then my goal was to just do financial planning as a hobby, maybe a side hustle, a little extra income, and with the idea that in time, maybe I do part-time dentistry and part-time financial planning. And so I cold called a bunch of CFPs in my little town in Medford and asked them if I could do free financial plans just for my friends under their supervision, because you need 4,000 hours or 6,000 hours of supervised work to become a CFP. And I found someone who said they'd let me do it. And so I started doing plans for a few people in town and for my buddies in dental school. And I just loved it. I just absolutely loved it. I had taken my Series 65 exam previous to this, so I was legit, and just found this passion. And that all coincided with the worsening of the back pain. And so once I made the successful claim on my disability policy, I took that opportunity to also change careers and to step into something that I feel is a better fit and something that I have absolutely loved these past few years doing.
So you bought a policy, a typical type we recommend here, an individual policy, specialty specific, own occupation policy, and then basically got a disability that kept you from doing that specialty, but obviously doesn't keep you from doing any work at all. And so now you collect the disability, and you're paid for your other work.
Exactly. Yeah, that is the beauty of an own occupation policy, right? Once my doctors and the doctors at Principal agreed that I could not perform the acts of clinical dentistry, the root canals and the crowns and the fillings, I started receiving my $7,000 a month check. And now I don't make as much being a financial planner as I did as a dentist, but that's okay because I get my disability premiums, my benefits paid to me each month. And that helps fill in the gap and gave me this sort of safety net, this opportunity to transition careers.
Do you wish you'd bought more disability insurance?
I really do. Yeah. So one of the mistakes I made is I got cheap with my premiums, right? I felt the squeeze as a dad with young kids, and Megan wasn't working at the time. So seeing my benefit increase was great, but seeing the premiums increase was really painful. And so when I stopped utilizing that future benefit increase rider, that ended up being a $2 million mistake, right? I'm very grateful for the $7,000 a month tax-free that I received from Principal that's adjusted for inflation. And if I would have continued to utilize my increase rider, I'd be getting maybe $10,000 or $12,000 a month tax-free. When I started collecting in my late 30s on a policy that pays out till age 65, and when you account for the adjustment and inflation, I made a $2 million mistake because I didn't want to pay an extra $800 a year in premiums.
Yeah. I mentioned earlier, we're trying to make sure our messaging is really where it needs to be for all of you out there, all the white coat investors. And, we've done a lot of work on disability insurance in the last year here at the White Coat Investor. We've tried to make sure, number one, that we make it as easy as possible for you to get disability insurance. And number two, made sure we got the very best quality folks with the best training selling you those disability insurance policies. So we're collecting a little bit more information on you, and we refer you out to them. But we're also, collecting a lot more information on the work being done on your behalf, and that allows us to increase the quality for that. But as I see the numbers of people buying disability insurance, I'm shocked how few doctors are doing it, because I know the referrals we send from the White Coat Investor are a pretty big deal in the industry, and it's not that many. I mean, there's 30,000 docs coming out of residency every year, and between dentists and physicians and similar docs, and so I figure probably half of them at least need to be buying an individual disability insurance policy. And with the insight I now have into the industry, that's not happening. It's not even close. There's a lot of people out there who need insurance who aren't buying insurance. And so I just want to emphasize to you, if you're one of those people out there and you don't have a solid plan to rely on your spouse's income or something, or happen to have a particularly good plan through your employer, which most people don't, even if they have an employer provided disability insurance, and you're just thinking this isn't going to happen to you, that's too big of a risk for you to be taking. This is your most valuable asset, is your ability to turn time into money at a very high rate, and you need to insure it. So as part of that, if you're out there and you're living on your disability insurance benefit, or you were disabled without disability insurance, I'd like to hear from you. I think it'd be nice to bring a few people on the podcast, whether it's the regular episode or whether it's the Milestones podcast, to actually point out how frequent this happens. I've met lots of people over the years who have been disabled as doctors, and it's not uncommon at all. But I think too few of us actually know somebody that has happened to. So if that's you, I'd like to hear from you. You can email us, edgar@whitecoatinvestor.com, and we'll figure out a way you're comfortable with in sharing your story on the podcast or blog, etc. All right, I think we've teed up our first question from a listener here pretty well, Tyler. So let's start with taking a listen to that.
Hi, Jim. This is Emil. I'm a radiation oncology physician in the Midwest. I'd like to thank you for all you do. You turned me from a financial illiterate to someone who feels relatively comfortable in about 6 months. My question pertains to disability insurance. My wife and I are both radiation oncology physicians, making about $400,000 a year each, and we have disability through work up to $5,000 a month. Given that we're both high earners, we wouldn't necessarily need additional disability, but my fear is that given we're starting the family plan and that we typically carpool and spend a lot of time together, that anything that affects one of us could affect both, like a car accident. So I was thinking about taking out additional disability insurance, but I was thinking of just doing it for one of us, probably me, given that I'm a man and it would be cheaper. I would like your thoughts on that. And also, radiation oncology is a specialty that generally does not require any procedures, any use of your hands other than maybe using a computer mouse. So I guess my question is there really a benefit to me having a specialty-specific policy as opposed to just an own occupation? I just can't imagine a scenario where I could work as another type of physician, but not a radiation oncologist. Really appreciate your thoughts and advice. Thank you.
All right. There's a lot of questions in there. A lot of stuff to talk about. Let's get started. You want to start off, Tyler, trying to answer some of Emil's questions?
Sure. Yeah. First, let me just validate, Emil. I get the hesitation to buy personal own occupation long-term disability insurance. It's really expensive. But the reason it's so expensive is because it gets used a lot, right? 1 in 6 physicians or dentists will make a claim on their policy during their career. That's a lot of payments being paid out, and insurance companies are not in the business of losing money. So they charge a lot in premiums. And as we just talked about, I'm one of these people. I'm on long-term disability, and I never thought that would be the case for me. And the premiums were off-putting. So I get it. And I want to validate the impulse to think twice about buying an expensive product. And at the same time, as we're talking about, I really want to encourage docs to be thoughtful and intentional about this choice. And the default should really be to get it.
Yeah. It's hard when it's the two-spouse thing, right? They got 2 spouses. They each make $400,000. Let's not kid ourselves. Most families in America are not going to have trouble living on just one of those $400,000 incomes, right? If that is your plan for disability, I don't think it's unreasonable. I don't think that's crazy to go, you know what, I guess it's possible we could both get disabled, but it's probably not very likely. And I don't think that's a crazy risk to take. If you are married to a stay-at-home spouse, if you are single, all kinds of other situations, I think that is too much risk to take. If you spend, a good chunk of your income, of that $800,000 income, that second income, if you're really actually using it to live, well, you better insure it. right? If it would be a big deal to cut back to $400,000 based on your lifestyle because you got, some really expensive house in the Bay Area, well, maybe that's someone who does need to buy coverage. I thought it was very interesting that he talks about having adequate coverage being $5,000 a month for each of them, right? They're living on $800,000. And if they're both disabled in a car wreck, they're now going to live on $120,000. I mean, that is a dramatic change, right? I get that, you really only need to insure what you're spending, but there are very few physician families in this country making $800,000 a year who are only spending $120,000. There's not a lot of you folks out there. If you are, you're probably hitting FI very quickly and can drop your disability insurance anyway. But they just sound very, very underinsured to me. There's a big problem though with those employer policies, right? They are not as good. Not only are they not portable, they don't go with you when you go, right? If you change jobs, they don't go with you, but they're not as good. Almost always they're not as good. They got exceptions, and the definition of disability is weaker. There's a reason your employer buys them, because they're cheaper, right? And so you kind of get what you pay for in that space, and you don't have as good of insurance through your employer policy. Anytime you put an employer offered policy up next to what you can buy, a fully underwritten individual portable own occupation policy, it's not the same. There are differences, and those differences matter. It's not term life insurance where you're either dead or you're alive, right? There's 50 shades of gray when it comes to disability. And I think your situation demonstrates that great, Tyler. You don't qualify for Social Security disability because you can work. It's something. You don't qualify, but you do qualify to get your benefit from your own occupation individual policy that you bought.
Yeah, let's talk about employer provided policies. And I'll share some of my personal experience. When I was disabled, I was actually working at the dental school here in Salt Lake. And so I ended up making a claim on my personal policy and on my employer policy. And I really learned some things in that process. So there are some real limitations with employer policies. You mentioned one, they're not portable. And you can become uninsurable during that time you're at this job, right? What if you get cancer and you want to leave this job at some point? Well, good luck getting a personal policy. You're stuck at this job, or stuck hoping you find a job that's going to have another group policy without underwriting. I have a client who didn't get a personal policy after residency, went and took a PSLF qualifying job, almost there with PSLF, and his plan was to leave in a couple of years. Well, last year he got MS at 35 years old. And now he doesn't know exactly when or if the disease will progress, and is afraid that he's going to be heavily reliant on this workplace policy. So the non-portability is a big deal. Also, the denial rates are higher. So my personal experience, it took about 5 months to get through the entire process on my personal policy with Principal. And it required a lot of paperwork and phone calls and back and forth. But overall, it was not a terrible experience. I had a 90-day elimination period, so they paid me some back payments. And then things have been pretty smooth since then. But boy, my employer provided policy with the Hartford was an absolute nightmare. It took over 9 months. It took at least 10x the paperwork and time and emails, and only to get denied for the exact same condition under which I was approved at Principal. So, if you know someone out there with a Unum or Hartford policy at work that got approved, that would surprise me. That the denial rates are just a lot higher on those employer policies. They're also not non-cancelable and guaranteed renewable. Your employer can change or drop the policy at any time. You have no contractual guarantee of continued coverage. A sort of pragmatic thing I see with my clients is they say, oh yeah, I went to the new hire presentation and HR said that I'm covered up to 60% of my salary on this employer policy. And I say, oh, cool, send it to me, I'll look at it. And there's a little asterisk next to the 60%. And that asterisk is the payment cap. And I most often see these cap at $10,000 a month, sometimes $15,000 a month. And boy, that can be news to a lot of people. If you make $500,000-$600,000 and you thought you were insured to 60%, suddenly you're getting $10,000 a month if you can even get it. That insurance may not be adequate for you. Also, these policies have a bad habit of saying that they're own occupation, but when you read the fine print, they're only own occupation for 2 years. And then they revert, in many cases, to an any occupation policy. The benefits are taxable. That's something you've talked about, Jim, on the blog, because the employer policies are often paid for with pre-tax dollars. The employers are getting a tax deduction for paying that benefit. So the IRS says, hey, if you're paying the premiums with pre-tax dollars, we're going to tax the benefit. So you have to reduce your projected benefit by some reasonable tax rate. It may not be your current rate, as your income is going to be lower on disability, ostensibly, but some portion of that benefit will be going to the government. And then one of the biggest surprises to me was when I went through this, that I found out that the benefits can be reduced by any work I do or reduced by my quote unquote capacity to work based on my education and ability. So the lady at the Hartford told me that if I am approved, that after 2 years of benefits, my benefit would be reduced by the salary of any job available within the Salt Lake metro area suitable based on my education. So if they could find a job that they deemed was appropriate for me, they would find out what that job paid and reduce my benefits accordingly. So to recap all that, if you have an employer policy, that's great. That's certainly better than not having one. But in my opinion, it is not something that you want to rely on exclusively to provide for income replacement in the event of your disability.
Now, when I was paying for disability insurance, I don't pay for it anymore now that we're financially independent. I had 2 policies. I had an individual policy that I bought. Mine was through the Standard that I bought, top-notch portable policy. I picked it up during residency, exercised an increase on it. And then I had one from my employer. And the benefit of the employer one, the reason I kept that is it didn't have the exclusion on it that my individual policy did. I had an exclusion that if I got injured climbing or doing something like that, it wouldn't pay. And so that was the benefit. That's why I kind of split my coverage. I had the good policy that didn't cover climbing and the not as good policy that would cover climbing. And so that may be one reason to use your employer policy. But I like the idea of not relying on it exclusively. And I think there's a lot of wisdom to that.
So yeah, if we've convinced you that having a personal policy is probably a good idea, the next question that comes up often is, well, how much should I buy? How much coverage is enough? And I'll just say that reasonable people can disagree. And ultimately, the way I frame this for clients is the deliverable on insurance is really peace of mind. That's what you want. You want to be able to sleep well at night, enjoy your life, not be stressed out about this stuff. So I tell people to get enough that they have peace of mind, that's the metric they should use. But some of the guidance that we provide in that conversation is that first, the coverage needs to be enough, not just to cover your expenses, but also any college savings you're doing for your kids, and particularly your retirement savings as well. These policies stop paying at age 65 or 67, so they are not a retirement plan. You still have to save for your own retirement if you don't want to live on Social Security. Now, that being said, to Emil's question here, being married to another high earner is a pretty nice insurance policy unto itself. So I think it's reasonable to consider carrying less insurance on each of you than if this was a single provider home. But I don't think it's reasonable to have it on just one person and to sort of arbitrarily choose the male because it's less expensive. It's more expensive for women for a reason. Their chances of making a successful claim are higher. And so that's priced in. Another consideration that can justify less coverage is what I talked about earlier, the example of my own story. One of the benefits of an own occupation policy is that you can probably still work. You probably did not get hit by a bus or fall off of Half Dome with Jim. My disability prevents me from from
Although
doing.
if you fall off Half Dome, you are probably not disabled, I might point out. You're going to need to collect on that insurance policy, but it's not your disability insurance.
All insurance has value for different activities. So yeah, you probably didn't get hit by the bus, right? And so like I can't do clinical dentistry safely for myself or my patients, but I can be a financial planner. I could teach didactic classes at the dental school. I could review insurance claims for a dental insurance company. And again, I don't make as much at this job as I did as a dentist, but that's all right because the disability fills in the gap. Also, Megan works now, which didn't used to be the case. And we found ways to cut some expenses, post disability. So buying insurance is not the only way to return your financial life to pre-disability levels. There are many levers you can pull. I just want everyone to be thoughtful and intentional about what their plan is in the 17% chance they find themselves in this situation.
Yeah, absolutely. Well, at least Megan's got a really good 401k plan, right? That's the important thing. Did you mention about how they don't, I can't remember if you mentioned how they don't really pay after age 65 or 67. Did you mention that?
Yeah, agreed.
Okay.
Yeah.
Yeah, I think that's a really key point. You have to have enough benefit, not just for your expenses, but also to keep saving for retirement on the benefit. Otherwise, it's only Social Security when you get into your mid 60s. So a lot of important stuff here. If you need help, if you're like, I don't know who to trust, I don't know where to get disability insurance, we put that together for you. I say we here at WCI. Obviously, I have a conflict of interest here because we have advertisers that sell disability insurance. Tyler doesn't have a conflict of interest. He's a fee-only advisor, but I have a conflict of interest. But these are people we vetted. They work with dozens of white coat investors every month. And dozens, hundreds maybe. And if they're not doing good service, we hear about it very quickly. And we either fix it or we get them off the list. But you can find all them, whitecoatinvestor.com/insurance. That's the place to go. All right. Emil asked more stuff we need to talk about. One of which he didn't ask about, but should have. It sounds like his big fear is both of them getting in a car wreck. And I think it's important to point out that most disability is not trauma. It's not falling off Half Dome. It's not getting in a car wreck. It's medical. People get cancer. People get degenerative disc disease. People get rheumatoid arthritis. People get MS. That's what disability is. That's what people are going out on for disability. They're not going out on, a train accident. So I think that's an important point to make. Do you know any statistics on that, Tyler, what the percentages are, medical versus trauma?
Yeah, I actually talked with Matt Wiggins at Doc Insure, one of your recommended providers for disability insurance. I talked to him last night in preparation for this, and he was telling me that 60 to 70% of the claims are illness, not an injury. And yeah, it's what you mentioned. It can be autoimmune disease, neurodegenerative diseases. He said there's a ton of mental health claims. And yeah, you only get paid out 2 years for that. But depression, anxiety, alcoholism, these things take root as people burn out. And so, sort of Emil's point, I hear a lot. And this notion of what I just call the difference between proceduralists and quote unquote thinking physicians. And, so from the psychiatrists, I hear a lot like, what are we talking about? Own occupation. I just sit here, I'm not a vascular surgeon. And so how am I ever going to get disabled? Well, if you get throat cancer, and your job is to talk to your patients, that's going to be a real problem. If you get rheumatoid arthritis and you can't type chart notes, that's going to be a real problem. And so I think it's a reasonable consideration, but it's, in my opinion, not a reason not to do it. And, Matt talked to me last night about how the pricing of the policies is reflective of that. And he said, anesthesia and OB and neurosurgery, those premiums.
Dentistry, super expensive.
Yeah. Because those are the people making claims a lot. If the surgeon puts his hand in the snowblower, that's the end. And that's not the case if you're a psychiatrist. But because of that, the premiums for pediatrics and psychiatry, it's a lot lower. So to Emil, I would say, hey, you're going to get radiology pricing. So don't feel like you're getting, paying someone else's premiums in some pooled product. And the other thing Matt pointed out is that those quote unquote lower paying premium specialties like peds or psych, that an own occupation policy is only like 10 or 15% more expensive than in any occupation policy. So it's essentially
like Social Security.
Yeah.
When we're talking any occupation, we're talking about qualifying for Social Security. It's got to be that bad.
Yeah. So it's kind of a no-brainer. It's a tremendous value add to add the own OC specific. In any case, but in Emil's case, if you're like, oh, hey, I'm a radiologist, you're not going to be paying that much more for an own OC. And I know you're sitting there, reading films, clicking buttons, but more things than you realize can get to you. If you end up with a neuromuscular issue like me and you can't sit in a chair in the dark reading films for 8 hours, you might find yourself on claim in ways you didn't realize.
Yeah. I got to correct you too, Tyler, because these are two different specialties, radiology and radiation oncology, two very different things. And lots of radiologists these days are proceduralists. They're doing all kinds of procedures with their hands. And so I've never done a radiation oncology rotation or anything. I don't know exactly what they're doing, but from Emil's description, it sounds more, psychiatry-like as far as your, physical use of your body. That's not always the case for radiologists, though. So, but that's all worked into the pricing. I totally agree with you, right? If you're a dentist, if you're an orthopedic surgeon, you're paying pretty good premiums for the fact that it doesn't take as much of a disability to disable you. Emergency medicine's there as well, not quite as expensive as those specialties. And as you move into pediatrics, as you move into psychiatry, as you move into PM&R, as you move into radiation oncology, that's already priced in. You're already getting a discount for the fact that you're less likely to have something that's going to keep you from doing your own occupation. But the bottom line with disability is get something in place, right? Because I feel bad for Tyler, right? Tyler got disabled, can't do dentistry, his income went down. But you know what? He did find something he can do that pays reasonably well, right? In the terrible situation where you're utterly and completely disabled and can't do anything, that's when you really need coverage. And so, having something in place is better than nothing for sure in the event that that's the sort of thing that happens to you. But for most docs, I think it's worth getting an own occupation policy. And what that usually means for most of these carriers, these insurance companies, is that it's specialty specific. It's not like you pay a different amount just to cover your specialty in most cases than it is to cover you as a doctor, right? They price it differently because they view your occupation as the specialty. But it's not like you can just go, oh, I just want own occupation. I don't want specialty specific. That's not really a thing. I think it's important to understand. All right. Have we beat disability insurance like a dead horse yet? I think we have. Go buy some disability insurance if you don't have any yet. You can cancel it when you're financially independent. You don't have to have it forever. And in fact, I think that's a pretty good idea. Some of the companies will give you graduated premiums, where you pay less in the beginning and then the price kind of goes up over time. Well, if you're one of those super savers that's going to hit FI at 45, that's a really good deal because you get the low premiums while you're actually paying them, then you cancel the policy. So not a bad idea. You can learn more about it from the agents. They're in it every day, all day. They know the ins and outs of all these policies. Can show you all the policies from the big 5 carriers and help you get the one that's right for your age, gender, specialty, state, and medical conditions. So you can find all that at whitecoatinvestor.com/insurance. All right, let's talk about a different subject. Let's talk about HSAs. We've got a question on the speak pipe about them.
Hi, Dr. Dolly. This is Joe from Minnesota. First and foremost, I want to thank you and everybody at White Coast Investor for all the work that you do on behalf of us physicians. I know my personal financial literacy has greatly improved thanks to your work. I have an HSA question for you. My wife and I are both physicians. Her healthcare plan does have an exclusion on spouses who are offered medical coverage through their own employers. So therefore, we've crunched the numbers and figured that it was most cost effective for her to have our children on her plan and me to be on my individual plan through my own employer. The question comes with HSA contributions. Historically, the whole family has been on high deductible plans, So we have either had one of us contribute the entire family limit or split it between the two plans so that our tax return does reflect a maximum family contribution. But this year we're expecting the arrival of a child. And so my wife will not be on that high deductible plan. Since I am on a high deductible plan that only covers me, am I able to still contribute to an HSA? A follow-up question would also be, I plan to save our receipts from her medical care during her pregnancy for this year. Are those costs still eligible for HSA reimbursement?
All right. Yep. We put a 90-second limit on those speak pipes. So if you got a really long question, you got to talk fast. You can skip all the nice things you say about me at the beginning. That gives you more time to ask your question. But I think we got the gist of his questions from this one. There's not a follow-up speak pipe, is there, Megan, for this gentleman? All right. I think the questions are pretty easy. His questions have right answers. There's not a lot to debate there, but let's debate about HSAs anyway. Tell me what you think about HSAs, Tyler.
Yeah. So first, a great question. Love talking about HSAs. Good for him for using it. And I get this question in a lot of different forms every year. And on its face, it seems like it should be a pretty simple question. But in reality, the math is really complex and these decisions are really hard. I heard a BYU professor compare this to playing three-dimensional chess because there's so many moving pieces with deductibles and co-insurance and out-of-pocket maximums, marginal tax rates, investment return assumptions. And so she said that she'd have to charge someone $25,000 for the consultation to have any chance to get a right answer. So if you're feeling lost on these decisions, just know that that confusion is justified and founded. So first, let me just say, I'm allergic to the assumption that just because someone is having a known high healthcare expense, that automatically means you should not use the high deductible health plan, which allows you to save into the HSA. This is a common...
You don't even think that should be a rule of thumb, that high spenders should avoid high deductible health plans?
Yeah, not necessarily. I think it is more nuanced than that. And so, sure, the high deductible health plan has a higher deductible, but that's only one of myriad variables to consider, right? The first is that the premiums are often meaningfully higher on the non-HSA plan. It's not uncommon for me to see a family save $2,000, $3,000, even $4,000 a year on premiums with the high deductible plan. That's a pretty big head start on your total annual healthcare expenses as a household. And that's before we start looking at the triple tax protected value of the HSA. The first of which...
I think it's really important that you actually look, though, because I've been surprised. I have people come to me, send me emails and go, my HSA plan is actually more expensive than my PPO plan. Well, should I still use it? And the answer, of course, is probably not, right?
Yeah.
But there's a lot of variation. I'm amazed. You would think the HDHP plan, the high deductible health plan, is always going to be cheaper than whatever the other plan the employer is offering. That's not always the case, though.
It certainly should be cheaper because you're paying more of your own money for when the kids got strep throat. You're not paying $30 for the copay. You're paying $350 for the office visit. So we would certainly expect it. But I agree with you. I'm astonished sometimes at the lack of logic in the pricing of the premiums. So yeah, I agree that the rule of thumb is let's just not assume anything. And let's look thoughtfully at each person's three-dimensional chessboard to the degree we can. Now, theoretically, let's say you are saving premiums, you have a logical plan, so that counts as favorable. And then we get our first layer of tax protection, right? We get a guaranteed tax savings on our contribution equal to our contribution times our marginal tax rate. So if you're in the 35% federal bracket and the 5% state bracket, then your $8,300 HSA contribution this year saves you over $3,300 on taxes. And that's not a tax deferral like a 401k. That's no tax ever. That's a really valuable tax savings, right? So now we've saved a couple grand on premiums and we've saved another few grand on taxes. Our head start on the high deductible health plan's pretty big. And then if we're not contributing, we also lose out on the value of additional compound interest over time, right? We can do the math on the after-tax value of $8,300 into an HSA versus $8,300 into a taxable account and compare the value in 30 years. And we can see how much we're missing out on by not filling that HSA bucket and using our stealth IRA appropriately. So these are largely quantifiable values that I think can and should be compared to the difference between your out-of-pocket maximums on both plans. And I'm just here to tell you that in most cases, when I do this math, the HSA comes out ahead, even if you are having surgery or a baby next year.
That's a good point. I'm not sure I've thought about that, but there really is the big head start, and you got to look at that high deductible health plan and look at what the maximum out of pocket is, right? If the maximum out of pocket, let's say your tax savings in this case is $5,000, between the premium and the taxes. If the max out of pocket is not more than $5,000 higher than it is under the PPO or whatever low deductible plan that you have, you may not be coming out ahead. And it's hard to know how much to add for the power of compound interest over the decades. That's a pretty fudgy factor, but it's worth something. It's not worth nothing. So you may very well be right that lots of people would still come out ahead. But boy, you sure do have to run the numbers. All right, let's answer the questions he asked. He asked, so he only gets to make an individual contribution amount this year. So for 2024, that's $4,150. He can't make a family contribution, which for 2024 is $8,300, unless he puts one of the kids on his plan. You only need two people to be a family, right? You only need, a parent and a child or two spouses. That makes you a family. You can make the full contribution. So if you had 13 kids, you could put 12 of them with one parent, and you could put one of them with the other parent, and still make a full family contribution. So keep that in mind. You may want to split people between it. What was his question?
And let me just chime in on that. One thing I see people forget a lot is that amount, 4,150 individual or 8,300 as a family, is inclusive of any employer contributions.
Right.
This is not like your 401k where you just put in your 23,000 and they put in whatever and you don't have to adjust. It's 8,300 employee plus employer.
Yeah, that's an excellent point. All right, I think we may have a little bit of debate on his next question. I see your notes here on our recording notes. I think you're wrong, but make your case for his next question about whether those receipts can be saved.
Okay, it's my understanding. I'm very open to be wrong. It's my understanding that if mom, who's on the non-HSA plan, if she has a baby and we save $7,000 of receipts and she's not covered at the time that the medical expense was incurred, if she was not on an HSA plan, that we can't fast forward 20 years and go back and reimburse ourselves $7,000 from the HSA because that expense happened at a time she was on a non-qualifying plan. But that I learn something new every day. So I wouldn't take that. I wouldn't bet my kid's life on it.
Yeah, I think you're wrong, and I'll tell you why. Let's take the 20 years out of the equation because I think it's irrelevant, right? The question is, can you use your HSA dollars to pay for the health care of somebody in your family that is not currently on a high deductible health plan? And I'm pretty sure the answer to that is yes. That once it's in the HSA, you just have to use it for healthcare expenses. That they don't have to be healthcare expenses incurred while you're under a high deductible health plan. That rule only applies to making contributions. It doesn't apply to how the money is spent. How the money is spent is it just has to be spent on health expenses for you or your family. And so I'm pretty sure that's legit, that you can actually keep that. Now, if the insurance company paid the expense, right, that's not legit. This is money you paid for healthcare, right? It's deductibles, it's copays, it's things you're getting receipts for because you wrote the check or use your credit card or whatever. If the insurance company pays for the delivery or for the appendectomy or whatever, you can't use that cost in 20 years and somehow use that to take money out of your HSA tax-free and buy a sailboat with it in retirement. But you can use it to buy health expenses that are legitimate in the list. There's nothing in the IRS guidance on HSA withdrawals. Number one, that says you have to take them out in the year you spend the money. And number two, that you can't take it out and use it for medical expenses even after you're on a totally different health care plan. And that includes for you, right? So let's say you're using a high deductible health plan for 5 years, and then you change. You go to a low deductible PPO plan or whatever, but now you've got this $80,000 HSA you saved up. Well, you can still use that. You're not excluded from using that just because you no longer have a high deductible health plan. I'm pretty sure I'm right. If somebody thinks I'm wrong, email us in and we'll get it corrected on a future podcast episode. I also, as you know from listening to the podcast, Tyler, I'm wrong a lot too, but I'm pretty sure I'm right on this one.
Great. I hope you're right. That would simplify it and be a boon for everyone. What I certainly think we agree on is that, or maybe just to clarify for people, that in the save your receipts strategy, which is a great strategy, let's do the fast forward 20 years and you reimburse yourself 30 grand or whatever because you want to buy a boat before you're 65. The only reason you would need the receipts is if you get audited. It's not like you need to include the receipts with the tax return, and the probability, the statistical probability that anyone's going to come looking or asking is probably low. Now, I think you should keep your receipts. I think you should scan them and keep them on a hard drive, and that's a good and ethical practice. But just practically speaking, in the real world, it's not like there's some way to upload all this document when you're filling out your tax return 20 years in the future. Is that fair?
Right. But I think if you claim 50 grand in a year, that's a pretty big red flag. I think there's a pretty good chance the IRS is going to ask questions about that, because it's not the way most people are using their HSAs. The way most people are using them is spending them as they go. And I think it's fine to save the receipts and pull the money out in one big lump sum after you've allowed compound interest to work on it for a number of years. I think it's perfectly legit. I just expect to get a letter from the IRS about it if you pull out $60,000 in a year, and hopefully you've got an IVF bill that you can send to them and say, "Yep, I really did spend it." But I think it's important to keep those receipts. And you make a good point about scanning them, right? You'll notice the ink used on receipts is crap ink on crap paper. And if you go back and look at some of your healthcare receipts 2 years later, there's nothing on the paper anymore. It's gone. So I think you really do need to scan them if you're doing that technique.
Yeah. One other thing that I think is worth mentioning here, at the risk of being in the weeds a little bit, but I recently learned this and thought it was
We never get in the weeds on this podcast, Tyler.
Impossible. So this was new learning for me, just like I learned something just now. I thought it was interesting, which is the option to have adult non-dependent children on your HSA plan, and they can contribute a separate and additional $8,300 to their own HSA, even when they're on their parents' plan, and even when their parents have already put the $8,300 in for themselves. So
Whoa, I've never heard of that one. That's cool.
Yeah, I read this in a Kitsis article, which Meg can link to in the show notes. So let's say we've got, right, because the Affordable Care Act allows kids to stay on until age 26, right? So let's say you've got a 24-year-old and they are no longer meeting the definition of a dependent, but they're still on the plan. Well, they can put in their own family maximum with either their own money, or mom and dad can put the $8,300 in, and that'll eat up $8,300 of their annual gift tax exclusion. But under either scenario, the adult non-dependent child can claim the $8,300 deduction on their tax return. And so that is
now even if they're not married, they don't have any kids, they can still do the family contribution?
That's my understanding from the article. Wow. I trust Kitsis. He didn't write it. It was a guest post on his blog. But, I find that no offense, I find that to be a equally valuable resource for me in my financial learning. And those are very long, detailed blog posts. So we can link to that. And that's how it's outlined there.
Yeah, that's pretty interesting. So the justification is that you have a family because your parents are also on the plan, or
Yeah.
it's interesting. Um, I'm a little unsure about that, but I can totally understand why you'd be able to do an individual contribution at a minimum, 4,150. I mean, the rules are that you're covered under a high deductible health plan and no other health plan, and you can make an HSA contribution. There's no other rule, you know. So that's a pretty cool little trick to think about. I'll have to read the article and decide whether I believe you can actually make a family contribution if you're single. That seems a little over the top, but let's look that up and get a little more information about that. All right, let's talk for a minute about these folks that get into super complicated HSA situations. Uh, Two doc family, they each work for a different employer. They've each got a different high deductible health plan. They're each getting matching dollars. How do they split up their HSA contribution?
Yeah, this is part of the 3D chess, right? There's a lot to consider here. And so, yeah, let's say we've got two working spouses, they both have access to a high deductible plan. And it can be good for them to each be on a separate plan, particularly if they both get employer contributions, because that's free money, right? It's like your 401k match. If the employer is going to put in $2,000 on each side, that's nice. That's free money. Also, once you get to age 55, that's when you're eligible for catch-up contributions in the HSA. And so if you're on two different plans, well, you both get the additional catch-up contribution. So that's nice. The drawback to being on two different plans is if you're all in a car accident or you all have a ton of medical expenses in the same year, well, now you have two deductibles, two out-of-pocket maximums you need to hit instead of just the one family deductible or limit. So that could potentially be more expensive. And then I don't know if you know more about this, Jim, but he mentioned that something he said, like, there's an exclusion on my wife's plan from health insurance because he's covered at work. I don't think that's legal. I think there can be spousal surcharges if one spouse has access to health insurance, but you opt onto the other spouse's plan anyway. But I would be surprised if it's legal to outright exclude someone from an insurance plan. Anyway, so that's an unknown for me.
Maybe they just use the wrong words to describe it. A big employer, I think they're unlikely to break the law if they've got some decent HR folks there. And that may be what they're referring to, is just that there's an extra charge to have more family members on the plan. Lots of places work that way. I mean, here at WCI, as the employee has to pay 20% of the premium. And so the premium is going to be higher if you have more family members on it. And so your 20%, of course, would be higher. And maybe that's the sort of thing that they're talking about. I don't know.
But yeah, the decision about whether to all be on one plan or to split it up, that's part of the complication. And it feels like a simple question, but man, when you really go down the rabbit hole, it becomes complicated.
3D chess. The good news is you're only playing around with, $8,000 a year or so, and whatever the premiums are. And so it's not the hugest piece in your financial plan, most likely. So hopefully, even if you get it a little bit wrong, it's no big deal. All right, let's do our quote of the day before we go to our next question. This one's from Jack Bogle. He said, "Don't look for the needle in the haystack, just buy the haystack." And of course, he's talking about index funds rather than looking for the next NVIDIA. Just buy all the stocks. And guess what? I owned NVIDIA before it got big. And so that's what you do too when you buy the haystack by using index funds. All right, our next question comes in by email. Hi, Dr. Dolly. Thank you all for all you've done and continue to do to help our community, even with your April Fool's jokes that occasionally give me an MI. I'm incredibly grateful for the wisdom and knowledge you provide. By the way, if you're not yet aware, that April Fool's post about PSLF being canceled was just an April Fool's post. All right, PSLF is still out there, so don't panic too much. And anybody who got an MI from it, I'm very sorry. Hopefully you recovered okay. All right. I am a 42-year-old married radiologist making about $450,000. My question is about simplifying our investments. Under your guidance, I've recently fired the financial advisor I've been working with since I finished residency, and I'm excited to DIY my investments and be rid of the 1.25% AUM fees that advisor was charging. Wow. Well, I'm glad you were able to get away from that. Remember, my advice when you fire your advisor is to first have your plan in place, then fire your advisor, of course. After reviewing the holdings in our IRAs and taxable account, I found they contained 37 individual stocks, 29 ETFs, 18 equity mutual funds, 4 bond funds, and 3 CDs. All right, I agree. The advisor needed to be fired. The taxable account has a market value of just over $1.4 million, with about $150,000 of unrealized gains that are mostly long-term, but due to the active trading, some have been owned less than a year. Active trading, a gazillion individual stocks, 29 ETFs. Yeah, this is not someone who's been getting high-quality advice. And the worst part is they're not paying a fair price either, that huge AUM fee. My intention is to switch everything to a simple 3-fund portfolio. That's fine. With an overall 80-20 asset allocation, that's probably fine too. How do I go about this? Should I sell all these funds before or after I transition to Vanguard? Should I wait until everything has long-term capital gains treatment so I just owe 15%? Or just clean it up now, knowing some of it will be taxed at a higher rate? Also, we just found out that our roof needs to be replaced. My wife's car died when it rains, it pours. So we were suddenly facing about $80,000 of unexpected costs. Should I use some of the proceeds from the sale of the taxable account funds to pay for these expenses, or utilize a HELOC for the roof and finance the car? Thanks in advance for any insights you can provide. This is the sort of thing that drives people to a financial planner, isn't it, Tyler? They start getting all these questions about what they should do next. And so there's a lot of good stuff here. We're going to talk about legacy investments. We'll talk about debt versus investing. And we'll talk about capital gains taxes. So why don't you go first, Tyler? Give your thoughts. This person just walked into your office and needs financial advice.
Yeah, I'm glad you're here. I'm glad you're improving on your situation. Good for you for taking it on. And there's plenty to talk about. First, maybe just a cleanup of something I heard there, that some information about what he's expecting his long-term capital gains tax rate to be. So it is true that at your income, your federal long-term capital gains tax rate is 15%. But the state of Ohio is going to want some of that. And because you make more than $250,000 on your modified adjusted gross income, you're subject to the net investment income tax of 3.8%. So your long-term capital gains rate is 15% federal, 4.8% Ohio, 3.8% net investment income tax. And that tax is, of course, part of the Affordable Care Act to help pay for that plan. So bad news, your long-term capital gains rate is 23.6%. Now, that being said, whatever capital gains rates you pay, even a mix of short or long-term in this case, is a pretty small portion of your overall taxable account balance, and sounds like pretty close to what a year or two of AUM fees would have been anyway. So my initial impulse is to just clean this all up at once. And so, the math, if you've got $150,000 in gains, 23.6%, you're going to owe about $35,000 in taxes, maybe a little more if some of them are short term. And $35,000 is about 2.5% of your $1.4 million taxable account. I think that's a pretty small price to play for creating simplicity, and is only 2 years of what you would have paid your advisor anyway. Now, that being said, so my impulse is to clean it up all in one motion. But a lot of times, a lot of the gains can be traced to just a small number of stocks or funds, and sometimes it can be worth hanging on to a couple of the keepers so that you can avoid those taxes if that feels painful to you. Now, that can be a little complicated to maintain these legacy investments, build your 3-fund portfolio, and have an overall asset allocation that you want. So I tilt towards simplicity, but I wouldn't provide any major pushback if you decided to keep 2 or 3 of the winners for a little while.
Yeah. Legacy investments, it can be tricky. Lots of people have this question. They finally became financially literate, and then they realize they're sitting on stuff they want to change away from, and there might be consequences to it. Point number 1 that I think everyone needs to have crystal clear in their mind: is if it's in a retirement account, if it's in an IRA, if it's in a 401k, 403b, 457b, defined benefit plan, whatever, HSA, a 529, whatever. There are no tax consequences to selling it. So if you got something you don't want, sell it and buy what you want, right? No consequence at all. 2, you actually got to figure out what your gains are on every position and every lot of every position in that taxable account. And this probably calls for a spreadsheet. And if you're not okay with spreadsheets, you probably shouldn't be managing your own money. I mean, you really need to be able to do that sort of a thing in order to make proper decisions and be your own financial planner or investment manager. So make a spreadsheet, every lot of every security in that taxable account, and figure out what the gain on it is. Some things you're going to have a loss on. These legacy investments you don't want. Great. Sell them, right? Not only are you not having to pay capital gains taxes on it, it's going to help reduce your capital gains taxes from other things. A lot of other stuff you don't have gains on, or it's a minimal gain. Great. Sell that. And now let's see what you have left that you have significant gains on. And maybe you've already taken care of 3/4 of the problem in your taxable account. You might be down now to 3 ETFs and 4 individual stocks or something, just because of the way things naturally work. Now, at that point, you got to start going, is this something I can build around, right? So let's say you want to own, the ETF VTI, right? That's the Vanguard Total Stock Market Index ETF. It's a great fund. It's my favorite fund, right? I got 25% of my money essentially in that or something like it. But let's say your legacy holding is the iShares ETF ITOT, which is their Total Stock Market Index Fund ETF. It's the same thing, right? There's no way I would realize capital gains on ITOT in order to switch it to VTI. There's no way. It's the same thing. Yeah, you got to have 2 holdings in your account, but there's absolutely no downside to holding it long term. So, don't sell stuff like that you're okay holding, even if it's an S&P 500 index fund, even if the expense ratio is a little higher than what you'd get at Fidelity or iShares or Vanguard. You may not want to sell that sort of a thing. But if you got a terrible holding that you're like, wow, this is a 1.8% expense ratio, actively managed mutual fund, I do not want this thing long term. Well, now the only question is, do you sell it now or do you wait until you have a year and save the long-term capital gains taxes? I'm the type that likes to wait a year. I hate paying capital gains taxes at all, much less short-term capital gains taxes. I'd probably wait a year. But the first thing I'd do is I would say, do I have to pay these at all? I'm a fairly charitable person. We give a lot of money to charity every year. That is a great use for your legacy holdings, right? Just flush them out of your account, give them to your charity of choice, or give them via a donor advised fund. Then you can get rid of them right away and you get, all the charitable benefits. You do have to have owned it for a year, though, to do that, by the way, to get the full tax benefit from donating it. So I think that's a great way. If you're 85 and not in great health and you're going to die soon, right? Don't be realizing gains. Just wait until the step up in basis of death and let your heirs take care of it. And they won't have to pay any capital gains taxes either. So make sure somebody's actually going to pay the capital gains before you realize them early on there. But hopefully you can simplify things down, and then you can look at each individual holding, each individual lot, and decide, am I going to build my portfolio around that and just hold on to it? Or am I going to sell it, bite the bullet, maybe use some of the losses from selling the losers to eat it up, or even pay some capital gains taxes on it in order to clean it up? But I'm not a big fan of paying capital gains taxes. I pretty much don't. I haven't really. I don't pay capital gains taxes. I've got far more losses than I'm probably ever going to use in my life, unless I ever sell WCI or my home, that sort of a thing. But for the most part, I don't pay capital gains taxes. So it would be a real change in my habits to start paying capital gains taxes, Tyler. Maybe you're a little more comfortable paying them, but I don't pay them very often. I don't like paying them. If I had to get out of a crappy portfolio, I would. But I think twice about every single thing I was selling for a gain, and I'd probably wait until there was a long-term gain at least.
Yeah, we don't want to make unnecessary donations to Uncle Sam when we don't have to. And, just my lived experience of work, I've worked mostly with early and mid-career physicians, and they're growing in their financial acumen. They're getting there, but they don't want to they want it to be simple. That's what comes through is like, I have this thing and now I've realized the error of my ways. I want to pay the stupid tax and surrender my whole life insurance. I'm willing to pay 20 grand to clean up this taxable account and just get to the other side. There's something soothing about it and calming. They don't have to fret about what happens next. And I think that's reasonable as long as it's intentional, when it's quantified and they say, yes, I know that I'm paying X dollars in capital gains, and I do that knowingly and willingly in exchange for simplicity and peace of mind. That's fine. That not everything has to be optimized in every case, but totally.
The old behavior versus math.
Yeah.
Behavior versus math. The old classic argument.
I'm really learning that in this job, personal finance is about 90% personal and maybe 10% finance on the best days. And I'm maybe more marriage counselor than I am financial advisor. There's a lot of things going on that don't have to do with numbers. And so, but your points about donating the big winners to charity is great. And figuring out, if you've got even maybe VOOs in there, right? The S&P 500 fund, that has a high enough correlation with VTI that I don't think someone needs to liquidate that. They can build around that pretty reasonably. But not if you bought Snapchat, for $65 a share and it's worth $11 today. It's time to move on from GameStop and AMC and those things. So yeah, and then the other question there I'll take a stab at, see what you think to answer their question. Should they sell everything in the current place it's in or after it goes to Vanguard? I don't think it matters that much. My impulse is to do a in-kind exchange to Vanguard first and then sell everything at Vanguard. So you just get 1099 tax documents from one place, and that's maybe easier to keep track of in the name of simplicity. And we'll point out it's not always possible to do an in-kind exchange on every security. If Vanguard doesn't offer that security, you're going to have to liquidate it to cash anyway. But do you have an opinion on the order of operations?
You got to look at commissions. Sometimes they do cost you if you're a super expensive brokerage or something. I've done in-kind transfers before from my parents' portfolio, and it was cheaper to sell them once they moved over. I think we came over from this is a long time ago. This is when Fidelity and Schwab were charging commissions, I think, and I think it was a little bit cheaper. We moved it in kind, and then ended up cleaning it up once it moved over. I think is my recollection. It's been a long time though. But as a general rule, when you're escaping a bad advisor, people just want to get out. Get my money over to the other place. And usually you have to liquidate your IRAs, et cetera. You don't have to liquidate your taxable accounts. They can usually be transferred in kind. And usually the place you're going is going to have lower fees because now you're cognizant of fees. Now you're financially literate. So you're usually better off waiting until they get over there and then selling them. Half the time you're waiting for the gains to become long-term anyway. So it's no big deal to wait a little longer. All right, we got to talk about the roof and the car.
Yeah.
This is a millionaire we're talking about who's talking about borrowing money to buy a car, borrowing money to put a new roof on the house, and they got $1 million in taxable assets sitting there.
Yeah. So to just answer the question directly, yes, use the proceeds from the sale of the taxable account cleanup to pay for the roof, pay for the car. And HELOC rates are really high right now. Car loans aren't much better. And I'm just allergic to that behavior regardless of rates. And I'll add, take some of the proceeds and I'm presuming, based on the nature of the question, that we don't have an adequate emergency fund in place. So let's also set some of our proceeds aside into a high yield savings account or the money market at Vanguard, maybe typically 3 to 6 months of expenses. And let's park those somewhere liquid and safe so that the next time the furnace goes down or the transmission blows, we've got cash set aside and we're not taken aback by that expense. Also,
the best part about that right now is it doesn't cost you anything, right? Stick your money in the Vanguard Federal Money Market Fund. You're making 5.3% right now, right? There's almost no opportunity cost to having cash sitting around right now. So why not have a little bit bigger emergency fund? Meanwhile, if you want to borrow money for emergencies, the rates are through the roof. You can't even get, medical students are borrowing right now. A lot of people don't realize this. Their plus loans are 8.05% this year, right? That's for school. That's as good as it gets right now. You think your car loan is going to be dramatically better? Only if you overpay for the car.
Yeah. Yeah. So this gives me a chance to also talk about one of my favorite financial planning strategies or tools that's been really meaningful to me in my life. And that's what our founder refers to as squirrel funds. Sarah Catherine Gutierrez, who's been on the podcast before, she's from the South. And so she says really lovely, quaint sounding things like, we should create squirrel funds, by which we mean we recommend that clients set up a high yield savings account, and preferably one that allows them to create buckets or sub accounts within the high yield savings account. I personally use Ally for this. So Megan and I just have a joint high yield savings account, one account number, but within it, we've opened a number of different buckets or squirrel funds. And into each of those buckets, they're named, the buckets are earmarked for different categories of inevitable future expenses that we know will happen. We just don't know exactly when they'll happen or exactly how much they'll be. So for example, we've got a travel bucket, a home bucket, an out-of-pocket healthcare bucket, etc. So we send $833 a month via automatic monthly transfer. I don't have to do anything. And it just goes into our home bucket within Ally, sits there and earns interest. And then when we need a new, L-shaped couch, a sectional sofa these days is 10 grand, or, our roof needs to be repaired, we already have the money set aside in the bucket. And the rest of our automated, monthly, smoothed out financial plan is not impacted by this large episodic expense. This actually just happened to us last fall. We bought this house in Salt Lake 2 years ago. It was a rental before this, and we knew it was not well taken care of as a rental. And so sure enough, the furnace, the air conditioners, the hot water heater, they were all integrated somehow. The whole thing went out. I got a bunch of bids and was horrified to learn that it was like $44,000 to get it fixed. And that is a lot of money at our house. And that would have really derailed the rest of our automated financial plan. That would have impacted how much I can put in the girls' 529s, whether or not I could do my backdoor Roth or max out our retirement accounts. But I was really grateful that for many years, I've been sending money to my squirrel funds. And so I had 30 grand built up in the home bucket. And I needed to dip into my emergency fund as well. So I want to make the point that squirrel funds and emergency funds are two distinct and separate ideas. The squirrel funds are for inevitable expenses that we just don't know when they'll happen. The emergency fund is the safety net that sits underneath the squirrel funds. So I got 30 grand out of my bucket, got 14 grand out of my emergency fund. I paid the HVAC guys with my credit card so I could get my 2% cash back. And then I paid my credit card bill from the squirrel and emergency funds. And the rest of our financial life wasn't impacted. We didn't have to start eating Alpo or anything. We were able to make it through unaffected. So I just want to plant that idea out there. I wrote a blog post that talks about this, about some considerations for quote unquote moderate earners. And so I would suggest that for our emailer as well, not just to shore up these short-term cash issues with the proceeds of his cleanup efforts, but also maybe to consider an ongoing strategy to set money aside regularly so that the next time you need a car, there's already cash built up.
There's nothing quite like cash when you need cash. I think there's another important point we can make off this, and that's the amount you're putting in there. You said $833 a month is what you're putting in there. And the first thing I think about when I hear that is, boy, I want all those, people graduating medical school and wanting to buy a house to hear that number and say that is the cost of ongoing expenses with your house. It's going to be a roof here. It's going to be, a garage door here, whatever it's going to be, HVAC goes out. But that's what it costs. And people don't think about that. They just think about the mortgage. They don't realize that a mortgage is the minimum amount you're going to pay for your housing, and rent is the maximum amount you're going to pay for your housing, because when you're renting, all that stuff's the responsibility of the owner, of your landlord. So I think it's important to realize that it is not an insubstantial expense to maintain a house. This is a little bit different from a sinking fund. Have you heard that phrase, a sinking fund? This is for like if you got to make your, you got to make your life insurance payment once a year. Right? You're on an annual payment, and each month you got to put some money toward that. And so you put money in every month, put $150 in there every month, and after a year, the bill comes due again, and you've got the money sitting there, and you send it to the life insurance company. This is much more something that's, you don't know when you're going to spend it. You don't know exactly how much it's going to be. And so you just keep putting the money in there. I think the classic example for a squirrel fund, as you call it, would be a car, right? I tell people, when you pay off your car, make that the last car loan you ever have. Keep making yourself payments. Just make them to you. And that way, when it comes time to buy another car, you have the cash to do it this time. And I think that's a pretty cool trick at Ally Bank that you can do that. I've used Ally Bank in the past. I never divided up the account. We just kept a spreadsheet that basically said how much was in each one of the different squirrel funds. And as our wealth grew, we eventually got to the point where we're like, this doesn't matter anymore. We're not going to do this anymore. We're just going to lump all our cash together. But we sure did the exact same thing for many years. So I think it's a great practice and definitely endorse it. All right. Megan's giving me that look. I think we've been going too long, so we better start wrapping this up. As I mentioned at the top of the podcast, SoFi is helping medical professionals like us bank, borrow, and invest to achieve financial wellness. Whether you're a resident or close to retirement, SoFi offers medical professionals exclusive rates and services to help you get your money right. Visit their dedicated page to see all that SoFi has to offer at whitecoatinvestor.com/SoFi. It's whitecoatinvestor.com/SoFi. Loans originated by SoFi Bank, NA, NMLS 696891. Advisory services by SoFi Wealth LLC. Brokerage product is offered by SoFi Securities LLC. Member FINRA, SIPC. Investing comes with risk, including risk of loss. Additional terms and conditions may apply. All right, don't forget, call for speakers. Okay, the conference, February 26th through March 1st, 2025. It's going to be in San Antonio. Join our world-class speaking team. Yes, we bring back some of our most popular speakers every year, but we try to have new speakers every year as well. You need to apply by June 15th. There's hundreds of applicants each year, but that doesn't mean you won't be one of the ones selected. You can increase the odds of that by submitting multiple topic submissions. So don't just speak, experience WCI Con, get your full registration included, and be a part of that 3-day experience. Sign up at WCIevents.com. We'll tell you by August, announce it to the public by September 1st. Thanks for those of you leaving us a 5-star review and telling your friends about the podcast. A recent one comes in from Brad, who said, "What a great podcast. I recently started listening to the White Coat Investor podcast, quickly became my go-to source for financial advice. The host is a real asset to the show. His expertise and insight are invaluable, and he delivers the information in an easy-to-understand format. Topics covered are so varied and relevant that I never got bored listening. From investing advice to personal finance, Dr. Dolly covers it all. He also interviews some amazing guests that bring even more value to the show, like Tyler today. I would highly recommend the WCI podcast to anyone looking for sound financial advice, no matter where they are in their journey. 5 stars. We appreciate that review. Tyler, any last words of wisdom before we let people go?
No, I'm very familiar with that look you're getting from Megan, so we better be done.
All right. Well, keep your head up, shoulders back. You've got this. All of us here in the White Coat Investor community are here to help you be successful with the finances, your career, your family, and your life. So we'll see you next time on the podcast.
The hosts of the White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.